All right, we are going to go ahead and get started. So, good afternoon, everyone. My name is Alexis, and I am the Marketing Community Manager at North Coast Ventures. For those of you who don't know, North Coast is a Cleveland based investment fund investing primarily in early stage B2B software as a service ventures. We have more than 300 member investors and have deployed over $65 million into about 60 startups in the region. In addition, we have a group of corporate partners like Buckingham, Doolittle, and Burroughs that make up our Innovation Council, with whom we work on a local, regional, and multinational scale. These partners are dedicated to helping promote startup growth and sharing their industry expertise. To provide a medium to do this, North Coast launched a Lunch and Learn style webinar series where members of our Innovation Council will share their knowledge on a relevant and timely topic. Today, two members of the Buckingham team will talk through how companies can navigate a down round financing. For those unfamiliar with Buckingham, they are a corporate law firm that counsels executives and business leaders all over Ohio and beyond. With offices in Cleveland, Canton, and two Akron locations, Buckingham has offered clients sophisticated and practical legal services for more than 100 years. Joining us today are Buckingham attorneys John Stefanik and Derek Haynes. John serves as the firm's business practice group leader. His tax practice covers a wide range of general business matters with a focus in the areas of mergers and acquisitions, corporate governance, and business succession planning. Derek is a partner in the firm's business practice group and works with clients on complex corporate transactions, capital raises, equity and debt investments, and real estate development and investment matters. Now, in just a minute, I will turn it over to the presenters. A quick note that today's session will be recorded and a link to the recording will be shared later today. We also will be taking questions at the end of the presentation section. So please feel free to type your questions into the chat and we'll address them at the end. I will now turn it over to John to begin the presentation.
Great. Thank you, Alexis, and thank you, North Coast. Thank you, attendees. I know you're out there. I can't see you, but I hope you'll enjoy the presentation today. And I don't know what it says about where we are in the world, though, when we thought about a relevant topic, down rounds came to mind, depending on the industry, too relevant right now. So let's launch right in. So we're talking about down rounds today and just what you can do to navigate some of the issues that come up with the down rounds, not all issues, but many of the issues that you'll see. Some of this material will be relevant to management, founders, investors as you look to invest in a round, junior investors when you look to what protections you might have. So what is a down round? It's essentially a financing for a valuation lower than the last post-money valuation. And there's a number of causes. That's the Y up here. Poor performance obviously is a cause. The prior round simply may have been too rich. We'll see that sometimes, or it could be conditions in the overall market. Some of that out there right now. We're focusing on down rounds today. There are some alternatives, the most obvious of which is just to keep the valuation flat. We need more money. And rather than having it at a lower valuation, we'll keep the valuation flat. And as a trade-off for that, we may grant additional investor protections. So that is out there and something at least worth considering before a down round. What we're going to talk about today, start with assessing the existing protections in the corporation's governance documents, the board's responsibilities in connection with a down round, some of the issues associated with how do you face the public, what's the story to the public once, if knowledge of the down round is out there, how do you handle founders and employees? Founders may be significantly diluted in the down round, employees may have options that aren't worth anything anymore, and sort of dovetailing off of that point, how do we deal with underwater options? What are some of the options available? So we'll talk existing protections. So before, I guess while analyzing the down round and the terms of the down round, we need to look at the existing governance documents, primarily the certificate of incorporation, maybe a stockholders agreement. Some of the things we're going to talk about today, no impairment clause, pay-to-pay clause, and then various anti-dilution protections that might be found. These are protections you might negotiate when you're investing as what may someday become a junior preferred, but obviously, as you're looking at a new round, we'll have to look at what the rules are before we can decide what we can do, what approval may be needed. No impairment, I've got up here on the screen a sample no impairment clause. It can take a number of different forms. This one just generally protects the holders of preferred against impairment. 3 important points worth noting. You'll see the last sentence. This will not restrict the corporation's right to amend its certificate with the requisite stockholder consent. So if we have a provision that says these rights, the conversion rights, the preemptive rights, whatever they may be of the Series A preferred, we can amend the charter with a supermajority vote or 2/3 majority, whatever the case may be. Then obviously these rights can be impaired because we'll have the requisite vote. The flip side is that without that vote, they can't be impaired, and that's what this provision is meant to accomplish. Second important point is these types of provisions are strictly construed by the courts in Delaware. If you want them to extend to a merger, you have to expressly say that. You'll see in this clause there is a reference to merger consolidation. And that sort of derives from a Delaware Supreme Court case, Superior Court case, Elliott Associates versus Avitex. And in that case, there were approval rights at issue, and the court said if those approval rights or veto rights, we won't amend our charter without X% vote of the preferred. If those are to extend to amendments that occur in connection with a merger, then the no impairment clause has to say that expressly. So you'll typically see things like no amendment to the charter by merger, reorganization, merger consolidation, or otherwise. So it's important. And then on a merger, just thought it was worth noting a 2002 Chancery Court case, Benchmark Capital Partners. In that case, they had the buzzwords merger or otherwise, but it carved out something which might seem intuitive, a merger with a wholly owned subsidiary on the theory that it's all within the same group. But unfortunately, in that case, the rights of the preferred were impaired by a first step merger of a wholly owned subsidiary into the parent company. And in that case, the preferred was out of luck, even though there was a no impairment clause in there because it had that specific exception for mergers with subs. So something also to watch for there. So that's impairment. Another series of provisions to look for is so-called pay-to-play provisions. You might see a pay-to-play provision for the junior preferred that say, if we need more money in the future and you do not participate in this next financing round or that later financing round, or do not participate at some threshold level, then something bad will happen. And that can take any number of forms. I've got a couple of examples here. You may lose your anti-dilution protection. We've not talked about anti-dilution yet, we will. You may be granted new shares, shadow preferred shares that are less valuable or have less protective provisions than your current shares. You might be forced to convert to common. And in connection with that conversion to common, you might lose other contractual rights, such as preemptive rights or anti-dilution protections. And so that's sort of the stick. You're investing now, and you are aware that you got to pay to play. You got to pay to keep up with the latest and greatest. And if you don't, you may lose some rights. And that, at least, if anything, gives you the ability in the future, when the need for money comes up, to assess, is it worth it? Do I view it as worthwhile investment? Am I going to continue to throw money at this, or is it good money after bad? And as mentioned there, it's often the companion of preemptive rights. You've got the right to participate in a future round, and if you don't, these things are going to happen. And it's worth noting that while the certificate may not have these provisions in them, a Series B or a later preferred investor may impose them retroactively, just as a condition of its willingness to invest. Obviously, a function of the leverage and how badly the company needs the money, and how willing the Series B or the later round preferred is willing to put money in. So they may retroactively say, yeah, there's no pay-to-pay provision in the certificate, but anybody who doesn't participate, these are what the terms of the new preferred are going to be. Now, if there's a no impairment clause, the Series A may have the ability to block that, but they may ultimately determine that it's better to accept it and deal with it and move on than to block it, and then the company folds because we've run out of money. So that's sort of the stick. The flip side, you might see a carrot type provision would be a pull through, where you've got a provision in there that says if you choose to participate in the later round at some threshold level, then the shares that you currently have will be upgraded to the new shares, or rights with similar to the new shares. So that's the carrot to the pay to play provision stick. Okay, I would normally pause just as a knee jerk and say any questions so far, but obviously no mechanism there other than as Derek and Alexis, I guess as Alexis mentioned, you can enter them in the chat and Derek will get them, and we'll have time at the end to review any questions. So moving on to the anti-dilution protections. The certificate of incorporation may grant anti-dilution protections to the existing preferred, which would be triggered if there is a later issuance of shares at a price per share that is less than the conversion price that is attached to the current preferred. And that conversion price is the price at which the current preferred may convert into common shares, typically in connection with the liquidity event or a deemed liquidation. And so these anti-dilution protections, mechanically, it's done by adjusting the conversion price. So as I mentioned in an earlier slide, full ratchet and weighted average anti-dilution protections are the two you'll see. And with weighted average, there's broad-based and narrow-based. Full ratchet, pretty simple. The conversion price of the existing preferred is simply changed to the price at which the new shares are issued. This is the most dilutive, or has the potential for the most dilution to the existing shareholders, the common, the founders. And one consequence is it's particularly severe results if there's a small down round. And one of the issues or limitations of full ratchet is it's got no frame of reference or no context for the relative size of the current round versus the size of the last round. So even a very small issuance at a lower price could result in the entire previous round being ratcheted down to that lower price. Weighted average anti-dilution provisions, on the other hand, do take into consideration the relative size of the rounds and will result in less dilution than full ratchet if you have a small round now versus a larger round earlier. The two variants that we'll discuss here, broad-based, narrow-based. Broad-based takes into consideration all common stock outstanding on a fully diluted as converted basis, so warrants, convertible debt, etc. Narrow-based would disregard, and it would only look to the actual stock outstanding and deemed outstanding. Oops. Sample language, I'm sure most people in the audience here have seen this exact language a number of times. This is a sample provision for a weighted average anti-dilution clause. So CP2 is the new conversion price, what we're trying to solve for. CP1 is the existing conversion price. A is the number of shares outstanding immediately prior to the issuance, and you'll likely have a definition for number of shares outstanding in the certificate. If it's broad-based, that would include option shares that would be issued on exercise of options or conversion of debt or exercise of warrants. B, the number of shares of stock that would have been issued in this new round or deemed issued had the stock been issued at a price per share equal to CP1. And C is the number of shares actually issued in the deemed issued in the new financing. All right, we have a simple example we'll work through, and a highly unrealistic example, oversimplified example, but really illustrates the damaging dilutive effect of a full ratchet anti-dilution provision compared to weighted average. So our facts, Series A conversion price, $1 per share. Those are the existing preferred shareholders. And we have 1 million common shares deemed outstanding. That includes 750,000 founder shares actually outstanding and 250,000 common shares that would be issued upon conversion of the existing Series A. We also have options outstanding for 100,000 shares of common stock. And now we have a new financing round where, for whatever reason, we need to raise $5,000. And we're doing so through the issuance of new Series B preferred shares, 10,000 shares at 50 cents per share. So if our certificate had a full ratchet anti-dilution provision, the conversion price for the Series A preferred would simply be adjusted down to 50 cents per share from $1 per share. So instead of a 1-to-1 conversion ratio, one Series A preferred share converting into one share common, we now have a 2-to-1 conversion ratio. Broad-based CP2, which is the new conversion price we're trying to solve for, is $1 multiplied by A plus B. And here A is all outstanding shares plus the shares that would be issued on exercise of the common options, plus B. B is the number of Series B shares that would have been issued if the price per share was $1, divided by A, again, it's shares outstanding plus option shares, plus C. C is the number of shares that actually are being issued in the Series B raise at 50 cents per share. And with that formula, the conversion price for the Series A would be ratcheted down to 0.995. Hardly any movement off of the dollar, and that's primarily because of how small this round is. Narrow based, very similar, except A is 1 million versus 1.1 million. And you can see, because of the small numbers in this example, there really is no difference at 3 decimal points between broad-based and narrow-based. We look at summary. This is what the fully diluted ownership looks like after this raise with the 3 different approaches. See the note at the bottom. Pre-round, the founders had 68% on a fully diluted basis. Full ratchet, founders have their 750,000 shares. The options are still 100,000. Series A now, by virtue of their conversion price being dropped from $1 to 50 cents, those 250,000 Series A shares are now convertible into 500,000 common shares. Series B is the 10,000 shares issued, and that takes the fully diluted ownership of the founders down to 55%. Broad-based and narrow-based, no statistical difference here at 3 decimal points. The only difference between the ratchet, full ratchet, and the weighted average here is in the Series A line. Because the Series A conversion price has only dropped to 99.5%, now those shares convert into 251,200 shares instead of 250. Very nominal dilutive effect on the founders. And again, that is attributable to the fact that the first raise was 250,000 and now we're raising just 5,000. So yes, it was a lower price, but it was such a small raise that it shouldn't have as big of a dilutive effect as the full ratchet would. So you can just see the difference there, drop to 67% instead of 55%. And that is it on the existing protections. And now we'll move over to Derek with Board of Directors responsibilities.
Yeah, thanks, John. And just picking up where John left off, in regard to the unwelcome results, that dilution based off of a lower valuation, that's what creates additional risk for Board of Directors as it relates to down round financing. Stockholders who have been significantly diluted now seek a remedy. And the primary claim for these stockholders is a breach of fiduciary duty claim. So we'll just touch a little bit on what the 2 main fiduciary duties are of the Board of Directors relating to a down round financing. So just briefly, the 2 main fiduciary duties that are going to come into play in regards to the financing will be the duty of care and the duty of loyalty. So we'll touch base on the duty of the duty of care here first. Delaware law requires the amount of care that a director use, the amount of care which an ordinarily careful and prudent men would use in similar circumstances. In regards to a down round financing, this would require that the directors, prior to making the business decision, that they inform themselves of all material information and act in good faith. And the duty of care really focuses on the process that the board of directors use as they undertake such financing transaction. And we'll talk a little bit on the next slide here as to what they should include in their process. So as a result of the down round financing, sometimes it's impractical to spend a significant amount of time identifying potential sources of raising debt and equity. However, to satisfy the director's duty of care, the board of directors should undertake, as reasonably possible, identifying all other sources of debt and equity potentially that wouldn't have as a dilutive effect of a down round. This would include even identifying potential opportunities for merger, sale, or bankruptcy, which would protect the common stockholders more so than issuing a down round at the lower valuation. If practical, and it's not always practical based on timing and financial considerations, but to hire an outside financial advisor who can really identify any other opportunities in the marketplace. Sometimes this isn't practical from a timing standpoint, or the company just does not have the funds to pay such advisor. So the duty of loyalty requires the directors act in good faith and in the best interest of the company, and not on behalf of such directors' own self-interest. And under Delaware law, the directors owe this duty to the common stockholders. So the general standard for legal review of a board of directors decision is the business judgment rule. Delaware provides the board with a presumption in their decision making, which will not later be second guessed if it is undertaken with due care and in good faith, even if the decision ultimately turns out to be unwise. So the business judgment rule is very favorable to the board of directors. However, this would be the standard unless 50% or more of the directors are interested in the transaction or the financing was with a controlling stockholder. And in the terms of a down round, it's a common scenario that the lead investor from, say, a Series A financing now is the only source of financing, but to undertake such financing, they would only do so at a lower valuation. And this is the type of scenario now that requires that the board of directors make such decision. And the result is that the court applies a higher standard of care and duty of loyalty. The court now will apply what's called the entire fairness standard. And this requires that the board must prove that the transaction was entirely fair to the minority shareholders, both in terms of the procedure in which they take and the substance of the transaction. This now is a much higher standard than the business judgment rule and comes into play quite often in the terms of a down round when a lead investor or an existing shareholder then makes a subsequent financing transaction to the company. And just to set up the common situation is that investors, especially lead investors, usually negotiate board seats with their investment. So if they had made a previous Series A investment, they've been able to negotiate a certain number of board seats. This could result in such lead investor having a majority position on the board, and it would also make those directors be financially interested in the down round, requiring the board to satisfy the entire fairness standard as opposed to the business judgment rule. So there's two parts to satisfy the entire fairness standard. There's the fair dealing, which is the procedural fairness. This would include the process that the board uses to, one, determine that such capital was needed, two, to identify the effects that such a financing could have on the minority stockholders, and two, the use of three, the use of an independent director or an independent director committee. Also, including in that process, identifying minority stockholders, and if there could be a lead minority stockholder to either seek approval from or require minority stockholder approval from all such stockholders. The second piece to the entire fairness standard is the fair price, the valuation. Most times it's impractical to obtain an outside valuation or to obtain a verification of such valuation just based on timing and the cost to do so. It is noted that courts will recognize a range of fair value, which provides some flexibility here to the board of directors. In regards to the financing terms, it's in the best interest of the board of directors to limit the financing terms that they give to the new investors on the down round. Such terms would be, as John discussed, liquidation preferences, anti-dilution preferences, and also board of director nominations. And now just to touch base on some efforts that the board can undertake to mitigate such risk. First is making sure that the board is fully informed of their fiduciary duties and their requirements from the process. It would be very prudent to have this documented in meeting minutes, which discusses that the board did obtain legal counsel and the fiduciary duties of the board was presented at such a meeting. In addition, the documentation procedure, the minutes should also include all of the alternatives that the board considered as opposed to the down round, which would go back to potential alternatives for equity and debt, and also potential opportunities for a merger, sale, or bankruptcy. Also documenting the board's basis for proceeding with the down round and the basis for determining that the valuation was fair. Again, this could be through an outside valuation firm, but it could also be through maybe a general market test and identify other potential equity and debt sources that the board of directors talk to. The main thing is to make sure that you document in the meeting minutes the process that was taken. Okay, so one thing the board of directors could do is to nominate an independent committee. This would be to take the independent directors, or at least one independent director, and to one, keep them fully informed of all the material information, but two, provide them with the right to approve any financing transaction. Also, depending on the cap table, you could require that such financing transaction be approved by a majority of the disinterested stockholders. And like I touched before, the more draconian the terms are for the down round financing, the more risk there is for the board of directors. So it's prudent to only give the terms that are necessary to satisfy obtaining the down round. And then lastly, a rights offering the existing stockholders the right to participate in the financing pro rata, which allows them the ability to take advantage of the lower round financing. Okay, now we'll talk about facing the public. So there's two overarching themes when we're facing the public. The first is transparency, and the second is to have a plan. In regard to transparency, it's best to just be open and honest to the circumstances for the down round, even if doing so requires you to identify some negative issues in the company's business plan. However, providing a plan moving forward for the future helps you then tell your story in a way that gives the public confidence that the business is still going to move forward. For example, the issue could be that a key supplier defaulted on its obligations, resulting in significant disruption in product manufacturing. So tell the story, be transparent about that. That's okay. But then also have a plan with your communication to the public that, for example, now the company has identified alternative sources in such product and has now created additional capacity. So be transparent, tell the negative story, but then also have a plan that identifies the positive outcomes that the situation could have. So our communications when we discuss the public are our customers, our suppliers, and the public. So our customers, obviously, we don't want the news of a down round to deter our customers to find other sources to obtain our product. With the suppliers, we do not want our suppliers to become worried that now we won't be able to satisfy our obligations under any type of contract. And then third, just the general public. It could be the marketplace. It could be other potential financing sources, or it could be, the venture capital community as a whole. Next, we'll discuss just facing our founders and employees. The same overarching principles of transparency apply, and also having a plan. So, tell the story, tell the negative impact or the negative issue, but then also tell the plan for the future. Tell the founders and employees how you are going to remedy the situation. You should have both a plan for individuals or founders who have equity in the company, and then also a plan for the employees who do not have equity in the company. In the plan and your communication to the employees, first, you should identify the worth of the employees and their continued efforts to the company. The news of a down round could make the employees feel like, well, are we hanging on? Are we working at a sinking ship? Issues that could result from that would be the mass exodus of employees, or founders now who have been diluted that basically say, this isn't worth my time anymore, and I'm going to go try something new. one idea to help combat this negative morale, especially for investors or for founders that have equity in the company, is to model out the potential waterfall based on multiple exit scenarios. For example, a sale of a multiple of EBITDA, model the entire waterfall structure, showing the entire proceeds to the founder employees. This would still provide some level of comfort to the employees or the founders that the ship is not sinking and that my options still have value here. Even though we've undertaken a down round on a potential sale of EBITDA, I could still cash in on my options. So that just presents a clear picture of what the practical scenarios are to the founders and employees with options.
Yeah, thanks, Derek. And the underwater option topic dovetails nicely off of that. I mean, I think that cap table discussion and comment is really valuable. If you can present the picture that, yes, we had to get more money and we had to do it in connection with the down round or at a lower valuation, but because of this money, we're going to do X, Y, Z now, and here's what's going to happen in 3 years. And if you can really paint that picture, tell the story, and show the founders and the key employees who hold options that there is something there for them at the end, it really goes a long way to retaining those people and to keep the founders happy. But with that, you may still find that the existing options just no longer have value. They're underwater, out of the money, and in that case, we have to figure out a way to do it, because obviously the reason you put the option plan in place in the first instance was to incentivize people, to make them feel that, hey, we're all building up to this huge exit, and when that happens, here's where you stand, because you've already given them a sense of what the cap table and what exit scenarios look like. So some of the options we'll talk about: issuing additional options, reprice options, replace options, or develop a cash bonus plan where cash would be paid in lieu of options, likely at a liquidity event. So additional options is an easy, I hate to say it, easy option, and it's simple to implement. You've already got the option plan. You simply grant more options on top of already outstanding options. You may need to amend the option plan in connection with the down round to increase the size of the option pool. But assuming that's not a bar, then simply issue additional options to the people who need to be incentivized. It's easy to explain to the key employees. They already know what the options are. They've already got options. They familiarize themselves with the option plan. And it also, the new options would be subject to whatever vesting schedule you have currently in the plan. So it's in a way to, to get more buy-in and to incentivize people to stick around, key employees. The cons, there's a lack of perceived value. So query how much incentivizing motivation, you get from these options. Hey, you've got options that are underwater, we'll give you more options. And these new options may not be underwater now, but they might still be perceived to lack value. You might have some of the mentality of, great, now I've got a larger percentage of nothing, which is the same. 10% of nothing is the same as 5% of nothing. And of course, we're stacking on options, and so that has a further dilutive effect on the founder common shares outstanding. But like I said, it is an easy path to go through, and it's effective, most effective when the common continues to retain some value. So depending on how far down the capital stack has been crammed down, how much value, how underwater the common is, will factor into whether or not this is a realistic alternative. Repricing options, that would be to simply reset the strike price of the currently outstanding options. So One benefit there is we're not stacking additional options on, so there's less dilution to the common. It's easy to implement, no consent needed typically. The employee may appreciate the fact that there's no new vesting. We're taking their existing shares that are already, their existing options that are already subject to a vesting schedule, and we're simply resetting the price, the strike price, to the current fair market value. Should be permissible. Options are generally exempt from 409A as long as the strike price is fair market value as of the date of grant. And repricing to the current fair market value should not be an issue as long as it's not part of a series. Under 409A, a series of repricings, if we're constantly repricing, would be suggestive of a floating option price, and a floating option price might run afoul of that 409A rule mentioned where the strike price has to be fair market value as of the date of grant. Assuming that's not an issue though, resetting the strike price could be a good alternative. Do have to watch out for some issues with incentive stock options. There's a $100,000 limitation. No more than $100,000 worth of ISOs can become vested and exercisable in any given year. And if the options that are being replaced or repriced have vested in the current year and the repriced options are also vested in that year, it'll be treated as if both vested in the year, which could push you over the $100,000 limit, which would have the effect of converting some ISOs to non-qualified stock options. You also restart the 2-year holding period that is attendant to ISOs when you do the repricing. So before doing a reprice plan, have to assess what effect it would have on ISOs if you have an ISO plan, and whether you can mitigate any of those issues with timing, and want to make sure to have an understanding about whether these actions would result in any ISOs being converted into non-qualified stock options. Another option is to replace options, cancel the options, and replace them with restricted stock units or restricted stock. The pros of RSUs or stock, full value award. If you're granting stock, it's, hey, here's shares. They may go up or down in value, but they're never going to be out of the money unless the company is truly worthless. So there's messaging around that. It frees up authorized shares. You need less shares of stock to incentivize employees versus options, which really represent a right to buy at the current valuation, so only the upside. Cons, rather than options for some larger number of shares, you're going to be replacing them with a smaller number of full value shares. So you'll have to deal with the messaging with employees, making them understand that this is a valuable award. And then the potentially negative tax treatment. If you grant restricted stock, that's fully taxable when vested, or if you make an 83B election when you grant, depending on the value of the company, that could be a tax issue, particularly if the employee doesn't have money to pay the tax hit. So you've got the phantom tax potential. And then with RSUs, the tax consequence doesn't occur until there's actually they've actually vested. So that's in the future, and hopefully the company has gone up in value then, and so there's even a greater tax hit. And normally you can deal with that with a net award of RSUs where a certain amount is withheld to pay tax, but still it's a little bit different than in the case of an option, which would normally occur on a liquidity event. So yeah, there's a tax hit then, but you've also got the liquidity event. So have to think through some of those tax consequences if you're going to pursue the RSU or restricted stock plan. And finally, the alternative is a cash bonus plan. Scrap the option plan altogether and tell employees, hey, key employees, we're going to put in place a cash bonus plan. When there's a liquidity event, you will get a cash bonus, and here's how it's going to be measured. Easy to understand. Everybody understands cash, flexible, cleans up the cap table. Some cons to be aware of, may limit exit options if the buyer, the ultimate acquirer, understands that they ultimately are going to be funding these cash bonuses. That may cool their appetite to do a transaction. And depending whether the people who are getting this cash plan are shareholders and other factors, the cash bonus may be boot And if the future exit plan is a tax-free reorganization, a stock-for-stock reorganization, the existence of this cash bonus could potentially jeopardize that tax-free treatment. So have to be aware of those. You also may need consent of the existing preferred before you can do the cash bonus plan, whereas some of these other options would not require that consent. So a couple of cons there to be aware of. And I think that is it for options. And that is it in general. We wanted to make sure we left time for Q&As, if any. It's 12:48. Not that we have to take the next 12 minutes with Q&As, but certainly if there are any questions, we'd be happy to entertain them at this point.
John, the one question I did have is, we're talking about a down round, and at the beginning of the presentation, you discussed as an alternative to the down round is just having a flat round, which would use the same valuation that was used in the prior financing. Could you just discuss a little bit of the impact that a flat round could have as opposed to a down round?
Yeah, I mean, the biggest would be, as far as I see it, is that you wouldn't trigger any of these anti-dilution protections. Some of the other provisions might be triggered, like a pay-to-play clause, et cetera, but you wouldn't have the dilutive effect on the founders. It also probably minimizes the risk to the board in planning and authorizing the round. So I think that would be the biggest. And then there's probably going to be trade-offs. So you've got some existing protections that might be eliminated in connection. You might have new protections that are granted. But if possible, it would be preferable to do the flat round to protect the founders, to protect against claims, and to avoid the anti-dilution.
Yeah, and I agree, especially as it relates to the board of directors liability, as the heightened liability results usually from a stockholder who's been significantly diluted. So it definitely would help in that instance. And then also a flat round would then prevent some of the negative consequences with both the public, your customers, your suppliers, and also your founders and your employees. Obviously, the line continuing is better than the line going down. So definitely think a flat round is an option if the investor is willing to invest there. Okay, so we have one question that asks about the duty of loyalty, and that duty of loyalty is to the common stockholders. And isn't there a duty to all stockholders? And the answer is yes, the duties to the common stockholders, and it's to all stockholders. However, relating to the contractual rights that a preferred investor may have, the duty of loyalty would not apply to those contractual rights. So the first instance in where the court would look would be how the common stockholders were affected by this type of transaction.
And then I'm not sure if you both saw, but there was also another question. Please define the public in a privately held situation.
Yeah, and I'll touch on this. So the public in a privately held situation is not necessarily the public investing community that you would have with a publicly traded company. So the public, as we discussed, it would be with your customers, suppliers, and then future investors. So that would be more the venture capital community as a whole. That would really be the public that we're talking about here. Investors of hedge funds that only invest in publicly traded companies, that wouldn't be our audience, but it would be more the audience of who could potentially be our next investor. And so I think those were all of the questions that we've had so far. So
Yeah, Yeah, it looks like those are all the questions. Just a reminder to all attendees that this recording will be emailed out to everyone this afternoon. If you do have any questions specific to your business or want to get in touch with John or Derek, we'll include their contact information in that follow-up email. So you can reach out to them directly with any questions, or if you'd like to have a conversation with them again about your specific business. But thank you all so much for joining. We appreciate your time and look forward to seeing you hopefully at another North Coast event soon. But thank you so much to John and Derek for taking time out of their day to present at this Lunch and Learn. Sorry, we actually,
thank you, Alexis.
real quick, sorry, we actually did just get another question that came in. How do you deal with a VC that often doesn't represent the interest of all stockholders as a director?
Yeah, so relating to this question, this really becomes the struggle then that the board of directors have. A lead investor may also have a majority position on the board of directors. And a lead investor then that requires a lower valuation for his subsequent investment really opens up the board of directors to potential breach of fiduciary duty claims. I think the best way to approach that would be that the non-interested directors require that the board of directors obtain legal counsel to present at their meeting and identify all of the fiduciary duties that the board would need to satisfy. I think that's probably the first and easiest way to address that and make it abundantly clear to that VC that who also serves as a director, that their actions could open up not only the other directors, but open up themselves as a director to fiduciary duty claims.
Great, thank you both so much. Attendees, if you have any other questions, please feel free to follow up via email. Thank you all so much. Derek, John, thank you guys for taking time out of your day to host this session. We definitely appreciate it. Any questions, like I said, follow up via email and be on the lookout for the recording. Thanks so much, everyone.
Thank you, Alexis.
Thanks, Alexis. Take care.